Here's the thing, for most investors, the last few months have created feelings of unease and tension, which I would say is appropriate given the volatility, the underlying risks, and the direction the market has taken. For many, the idea of a bear market may be a new and untested area, especially for young 20-something investors who may have started their investing career shortly after or a couple of years after 2008, which means you've never really experienced a bear market. So without further ado, let's talk about 3 easy and simple ways to protect yourself in a bear market. Number 1 is balance and delever. It seems more and more people have forgotten about or have ignored the traditional pillars of portfolio building, which is to have no significant exposure to any one position and to have a cash reserve. Data from TD Ameritrade shows that investors today hold less cash than in a near decade. Why? Well, a long-term bull market often tends to breed overconfidence. And as people gradually become more confident in what's going on in the market, they become less considerate towards risk, and then I guess you could say they bend the rules a bit more. We all know an investor or two who has all their eggs in 1 or 2 baskets, primarily in the FANG stocks. And you know what? For the last few years, that's probably worked out really well for them. But where we are today, the markets have changed, and it's probably best to sell off some positions that you're overexposed to and get that rebalance going, as well as building a cash reserve. I'd say 15 to 20% in cash is the way to go, with 5% to 10% max for any one given stock. Number 2, mind the debt. For nearly a decade, the Fed and other central banks kept interest rates at artificially low rates via buyback programs such as quantitative easing. It meant that corporations could borrow money for almost free. They also had an abundance of options in what they could do with that money, things such as stock buybacks, expansions, and heavy acquisitions, which were all beneficial. But now, with interest rates slowly creeping back up, the Fed and Jerome Powell will continue to raise rates, at least giving a few more hikes. So what does this mean, and why should we mind the debt? Well, higher interest rates mean 2 things really. It means a higher cost of debt, which hurts a company's earnings, and it means bonds and fixed income securities become more attractive. And as bonds and fixed income securities become more attractive, all things equal, more money tends to flood out of the stock market and into the debt market. The technical term in the world of finance is the risk premium. Because debt securities are predictable and considered riskless, or at least substantially less risky, when interest rates go up, stockholders now need to be compensated much more higher to hold their stock because there is risk associated with owning stock, and therefore the requirement on equity goes up. As we demand to be compensated higher for our risk, this increases the cost of capital, which essentially means corporations now have to perform at a higher standard. And when they don't, their stock tends to have a downward pressure type of momentum. So even if a business and their fundamentals are still intact, by simply raising interest rates, there is downward pressure on that company's stock. But the companies who have less debt tend to perform better. So when analyzing companies that you either own or intend to own, using ratios such as the debt to equity ratio, debt payback ratios, and debt relative to capital are a few important metrics that you can use to compare to competitors in the market as well as industry averages. Number 3, buy more downward protection. And one way we can protect ourselves from the downside is by buying put options. Combining put options with equity positions is called a protective put. A protective put, compared to a naked put, has slightly different motives. When you're buying a naked put, you're looking to profit off a stock or a security going down. Whereas when you're buying a protective put, even though it may be the exact same contract, you're combining that with the equity position, meaning you already own the stock. The put option is meant to offset any of the losses you have on your equity position. So let's say you own stock in XYZ company and you buy the stock at $50 a share. If you want to protect the downside, you can buy puts at $50 a share, meaning if the stock were to tank to say $30, $20 loss on a per share basis you lose on your equity position will be offset by the $20 gain or profit you have on your put. So in other words, your net loss becomes 0, excluding commissions. Put options are an attractive way to offset any bearish sentiment and bearish activity in the market in periods where you think they might ensue. So to summarize, delever and rebalance take into account the classical and fundamental pillars of portfolio building. You must consider debt, given that interest rates are rising, and buy downward protection via puts. With these 3 things, we think you'll be better positioned to survive this bear market. We want to thank you guys for listening, And once again, happy investing.